So in this video, I'm going to answer the question, so how does all this stuff work? And is all debt bad or is there good debt? Two excellent questions. How does all this work? Well, to break it down as short and concise as I can, is the infinite banking concept is the concept or the idea that you're paying more into an insurance policy to store your money. You're simply using that place as a storage facility just as you would a checking or savings account. Why would you want to do that? Number one, your money's safe. Number two, it grows compounded interest that's uninterrupted until the day that you die. That means that you're constantly saving interest upon interest and earning interest until that day that you die. Is there good debt when you're utilizing the banking concept? Absolutely. When you store money into your banking policy, let's say you've got $100,000 in savings and you want to go buy a brand new $30,000 vehicle. Well, you can take a loan out of your policy, pay cash for the vehicle, so that way you're not paying interest to another company. You pay yourself back whenever you want, as quick as you want, and if you ever want to pay yourself back. Because remember, this is your money. So when you get into retirement age, many people utilize the insurance policy as just a place to store and save their money that they can't be lost according to the market. We all know that in March 2020, there's a lot of people that lost a lot of money, just like they did back in 2008 and every time that the stock market crashes and hits a readjustment. So what the banking concept enables people to do is take loans when they would normally pay somebody else for that. Once they've paid themselves back, they become whole again. All of their money is back where it is. They paid interest back to themselves, so it didn't go to an outside company. And during that period of time, they've been able to have and use that vehicle, and they are liquid with their assets, meaning that they can always get their hands on that cash value. Once you send money away from your family to a bank for a car payment or a mortgage, that money right there is gone forever. You will never ever see that particular amount of money again. Now you can make more money, but that's different money. That is not the same money that's going to your mortgage company or to the bank that has a loan, that you have a loan out on your vehicle. So when you pay yourself back, you've not only gained all of the money back, but you've also been able to have flexibility. Because if you buy a car and you're the bank, are you going to repossess your own car if you can't make the payment next month? Well, a lot of people, when they run through trying times like we have today, and all of a sudden their income stopped, those of us that had a banking policy and had loans that we paid for ourselves to pay for our vacations or our new vehicles or for things that our children needed or living expenses, we have all the time in the world to pay ourselves back because we're in control. Is all debt bad, or can there be good debt? Well, depending on who you take financial advice from, and there are a lot of people with a lot of opinions out there, right? So let's think about in the terms of real estate. If you own your home and you have no mortgage, and you have no other debt, well, you've done one thing that's awesome. You don't have a monthly obligation to somebody else. But could your money, rather than being wrapped up in real estate in your home, could that money serve you better out in the marketplace earning an income? Well, let's talk about that. When we get down to paying off your mortgage, that's a different choice, and that might be different for different people. What I mean by that is, let's say, for example, you're in your retirement years and you have your money in either some type of business or some type of investment, and you're making more money than what it's costing you if you paid your mortgage off. Well, if your mindset is, hey, I'm better off keeping it where it's at, even though I'm paying the interest on the mortgage, and you sleep well at night, well, then your money's serving you well. However, if you've got a spouse and your spouse just wants to not have a mortgage hanging over their head, and you have the means to do that, is your money giving you peace of mind if you still have it in investment, especially if that investment has risks involved? If it's in real estate, for example, and your tenants can't afford to pay the rent and you have a mortgage on that, well, then you've got a risk. You have to be able to pay your bills. You have to be able to pay your own utilities, and you have to decide what's best for you. So in our consultation, when I work together with people, I look at the big picture, and if it makes sense for you and you understand the choices, then I think you've made the best decision for your situation. Because who's to say that paying off your mortgage isn't what's best for you? There's a lot of variables there. But when I go through a debt strategy with people, we have that in mind, and I can actually show people how to pay off a mortgage, even if you just refinance it for a 30-year term, in 9 years or even less. So that gives you 7, 8, or 9 years to decide, do you want to continue living in that home? Is that a home that you're maybe just going to live for the next few years, and maybe the next chapter of your life, it makes more sense to live someplace else and you're just going to sell that property? Well, those are some questions to maybe consider, because if you have all of your money wrapped up in your home and you don't have enough saved up in your banking policy and an emergency comes up, you can't eat your drywall. You cannot get the equity out of your home to buy groceries unless you do one of two things: sell your home, or two, get a home equity line of credit and have a mortgage on that property. Well, now you've added interest and expense, and you've also run into the situation that, hey, what if something comes up in the future and you or your spouse are unable to make that mortgage? Well, you might be forced to sell your home when the housing prices are the lowest of the low, rather than selling it when it's at the best of the best and get every dollar you can out of your property. So you want to make sure that you have the most liquidity and emergency funds set up. And in most cases, that boils down to paying off all debts, including student loans, where you only have your house. And then you can just look back and decide, hey, does that $300,000 sitting in my banking policy help me sleep better at night? Or should I take that money and wipe out my mortgage and not have to worry about a monthly mortgage payment? Those are things that we can discuss together, and you can decide what's best for you. Stay tuned for the next video in this series, where I'll be answering the question why I think everybody should have an infinite banking concept insurance policy as part of your family's overall financial toolkit, or another tool in your financial toolbox. Stay tuned, and I'll tell you why. In just a few seconds, the next video in this series will appear at the bottom left-hand corner of the screen. At the top left-hand corner of the screen will be the full webinar, which will answer 99% of all of the questions you have. Of course, don't forget to like, subscribe, and ring the bell so you'll be notified when I upload new videos each week. If you're watching this on a mobile device and directly on YouTube, there's a little arrow on the right-hand side. That'll open up the description below, where you'll have a link to our webinar, our learning center, as well as have the ability to book a consultation with me directly to see if the infinite banking concept and becoming your own banker is right for you.